Hey there, great people. Thanks so much for dialing in. Touching base to let you know that as with all of our content, this is general in nature. It does not take into account your specific or personal circumstances nor your individual risk profile, and as such should not be acted on accordingly. If you get value from this and you want to explore some things further, I strongly recommend that you get personal advice from a qualified professional. Hello, welcome. Happy to introduce Hugh Lam today. Hugh is going to help us this month get our head around cryptocurrencies, which is a hot topic. By the end of this session, this will be particularly of interest for those that want to know the ins and outs of crypto, the difference between cryptocurrency and the blockchain, and just understanding what to look out for when it comes to cryptocurrencies. Hope you enjoy it. All right. Hello. Welcome, Hugh Lam, investment strategist at BetaShares. Very lucky to have Hugh here today with us to help us unpack the big wide world of cryptocurrencies. Hugh, thank you very much.
Thanks for having me, John. Appreciate it.
Now, before we kick off around cryptos, I'd just like to get a good feel for your origin story, Hugh. So, yeah, how did you land at BetaShares in the role that you're in? Just take us a bit about Hugh Lam.
Yeah, thanks, John. So, my current role at BetaShares is an investment strategist. So what I really do is a lot of market commentary on what's happening in equity markets, also heavily involved with product development and providing support on portfolio construction. And I guess how I got here, I used to work at a research house called Lonsec, which you guys may or may not have heard of. And I was doing manager research there, covering Australian and global active equity managers. And prior to that, I was at Pinnacle Investment Management on their distribution team. So I've got a bit of experience on the distribution side and the research side. And I thought I'd join the big, beautiful world of ETFs at BetaShares.
Yeah, great. Yeah, long-standing experience and good to have you here today. So what we're wanting to unpack today specifically is around cryptocurrency and that as an asset class.
Yeah.
A lot of our clients are all stages when it comes to crypto. So some are deep in it, some are just crypto curious, and some are still just wondering if it's smoke and mirrors. Can you just help us with the 101 in simple terms? What is cryptocurrency?
Sure. In 101 terms, what a cryptocurrency is really digital money that is secured by something called cryptography. Now, cryptography, is effectively advanced sort of math that keeps these digital currencies safe. Now, in regards to regular money, the paper Australian dollars that you have, the difference with that is that cryptocurrencies, as I mentioned, they are purely online. They are secured by something called a blockchain, which we'll talk about a little bit later. And thirdly, it is decentralized. And what decentralized means is that no one owns that Bitcoin or controls it. So the bank, a company or government doesn't actually control that cryptocurrency. So at a high level, those are really key features that differentiates it to something like fiat or paper money.
Got you. And is that the real allure to crypto, the decentralized nature of it and the control that can be held?
Yeah, that's right. I think the allure comes back to that security. If we think about what really makes cryptocurrencies, it's the underlying technology, which is called blockchain. Blockchain is effectively a digital ledger. So think of a digital ledger just being a record of all transactions that a buyer and seller will have to record on a system. So for example, if you're purchasing a property and you need to give the money to the seller, there might be nuances on that. Someone can say that they haven't received the money yet, but what the blockchain technology does is it goes through a verification step. It effectively adds as an intermediary between said buyer and said seller. So there can be no lying in between that transaction. So everything's verified. And it's that security aspect through blockchain technology that makes cryptocurrencies exciting for many investors, but also users out there in this world.
Yeah, good. Thanks for that. So real key distinction is between the digital currency itself and then the blockchain technology that sits
exactly right.
Sits underneath it. Gotcha.
Yes.
And then when we're talking about digital currencies, is it Bitcoin versus everything else? What can you help us understand around Bitcoin, Ethereum, these types of names?
Yeah, it's a great question because Bitcoin and Ethereum are just two examples of cryptocurrencies. Yes, they are the most the biggest and most well-known cryptocurrencies, but there are other ones like XRP, Solana, Ripple, etc. Now, they do have slightly different use cases. At a high level, Bitcoin is historically and traditionally been viewed as a store of value cryptocurrency. And the reason why is because there's a fixed supply of it. And there's 21 million Bitcoin out there in the market. So if it's a fixed supply, then generally you're going to store that value quite well. Now compare that to something like Ethereum. Ethereum's a little bit more nuanced and flexible, where it uses an underlying technology that's used for something called smart contracts and decentralized finance. Not really seen as a store of value cryptocurrency, but definitely has very strong use cases in those fields that I mentioned. So every cryptocurrency has slight differences, but the main ones, as I said, Bitcoin and Ethereum, they still fall under that cryptocurrency banner.
Okay, good. That's great. It's good to distinguish between Bitcoin and the scarcity of it versus Ethereum. So just to tie a loop on all that, why do people
Yeah,
typically invest in it? Is it the
yeah,
store of value? Is it the speculation? Is it technology?
yeah.
What do you think the fundamental reason is?
Yeah, I think there are a myriad of reasons, just as in equity markets and fixed income markets. There are different sub-asset classes like Australian shares, international shares. At the end of the day, it's all shares, but they have different sort of differences. With Bitcoin and Ethereum, I think some people might invest in Bitcoin again for that store value aspect because there's a fixed supply. And some people might invest in Ethereum because of its use case in those things like smart contracts. So in areas like law, where things need to be really written down in hard code and there can't be any tinkering, that's where Ethereum can really play a key role. Store of value, yes, speculation is another one. Some investors just look at what's happening in the price movements of these cryptocurrencies and they've gone quite wildly. So you definitely do have some hunters out there. And also just a general bet on technology as well. Technology and AI has been a key theme in markets quite recently over the last few years, and cryptocurrencies have been really an enabler of that. So that's another reason why investors might be looking to invest in crypto assets.
Okay, great. Good summary. Thanks, Hugh. Just where does crypto sit compared with your traditional asset classes, Hugh? So things like shares, property, bonds, these types of things.
Yeah, great question. There's been a lot of debate actually as to where cryptocurrencies fit within the investment sort of ecosystem. I guess where crypto differs is that crypto doesn't have traditional cash flows,
Mm,
shares, bonds, and property.
mm,
And so when you don't have those traditional cash flows, it can be very difficult to get a sense of what value it is. Really, where the value of cryptocurrencies come from is how much people are willing to pay for it. So it is quite different to these other asset classes. And so that's why a lot of people have viewed crypto as an alternative asset class. Now, when you
mm,
think of an alternative asset class, generally these assets have lower correlation to those traditional ones like equities and bonds. But actually, more recently, we've seen an increase in correlation between stocks and cryptocurrencies as well. So I think from a portfolio construction perspective, investors do need to be wary of the changing correlations between Bitcoin and these asset classes. But traditionally, it's been viewed more so as an alternative for those reasons.
Okay, gotcha. So when you say correlation, you're talking about the way it reacts to those other asset classes are strong or weak. Okay.
That's right. So
Yeah.
if something has a low correlation, generally one asset class or one asset will do well. If it has a low correlation, then the other one will tend to do not as well in simple terms.
Okay, great. And so when you log into your share app or the Apple Stocks app and you've got the Bitcoin ticker in there and it
Yeah.
just seems to be flying up and down quite
Yeah.
rapidly, why do
Yes.
you see it as being volatile and potentially up and down?
Yeah. Yeah, so I just probably make a caveat to that statement. I think that has definitely been true in the early sort of years of Bitcoin, and maybe more so in 2020 when we had the COVID crash. But I would say that volatility in crypto, Bitcoin, etc., actually has come down quite a bit and stabilized. It is important to note that volatility of Bitcoin is still higher than those traditional asset classes, but it has stabilized over time. And the
Yeah.
reason is because we've seen factors like Bitcoin ETFs that BetaShares offers. There's a lot of consistent inflows into that. The US approved a string of US ETFs as well in 2024. That was another key factor that has led to rising adoption. And also the regulatory environment as well has cleared up. So we're seeing institutional investors increasingly step their foot into the asset class. So these sort of stakeholders, they definitely have more of a long-term buy and hold nature as opposed to a retail crypto trader who's coming in and out of the asset class. So that's why the volatility of
Gotcha.
Bitcoin has definitely stabilized a bit more over time.
Gotcha. So it's a bit more consistent, the type of investor that's in there
Correct.
and so on and
Yes.
so forth.
Yes.
Okay, great. And just your overall take on it as just your perspective as part of a diversified portfolio.
Yeah, sure. So I think where Bitcoin and crypto comes in regards to a broader portfolio is that generally this should only be a small allocation within investors' portfolio. I mentioned that volatility is still higher naturally than equities and bonds.
Yep.
And so you don't want to overload more than 10%, 20% of your portfolio into Bitcoin. So it's definitely it should be a small allocation. We can touch upon it a little bit earlier, but we launched and released a white paper with our index provider Bitwise that actually looks at the impact of a small allocation of Bitcoin to a broader diversified portfolio. Generally, we suggest no more than a 5% allocation.
Okay, great. I'll get hold of that white paper
Yeah.
and pop it in the show notes for everyone as well. Donald Trump, very topical at the moment. He's got his finger on the button, it seems.
Yeah.
And this concept of the Genius Act and regulation around Bitcoin.
Yeah.
So what is the Genius Act in plain English?
Sure. So what the Genius Act is, firstly, what it stands for, because I found it quite interesting why he named it, but it actually stands for something. So Genius stands for the Guiding and Establishing National Innovation for US Stablecoins Act. So what is it in simple language? In the name, it says stablecoins. So it effectively is a very transparent federal level law that regulates stablecoins. So I just wanted to unpack that a bit further. What is a stablecoin? Stablecoin is also another type of cryptocurrency in conjunction with Bitcoin and Ethereum. But where stablecoin gets its name from is in stable. So why is it called stable? It's because its value comes from the US dollar. So for every reserve that it has, it needs to peg that to the US dollar. So that can be in something like short-term treasury bills, etc. So again, there's a lot of interest in stablecoins, and a lot of corporates like Walmart and Amazon are looking to issue their own one. But yeah, effectively at a high level, the Genius Act provides a pathway for corporates to issue these stablecoins.
Okay, great. So in summary, Genius Act does have it's an acronym for something, and
Yeah.
it is making crypto holdings more transparent, more regulated. In terms of why is regulation such a big deal for crypto markets?
Yeah, regulation is extremely important for crypto markets. I would say that crypto markets have been heavily waiting for news around regulation and clarity around it because effectively, if you get clear regulation, then that's going to affect trust among consumers, prices, etc., and also affect adoption and liquidity. If we think of institutional investors like pension funds, asset managers, they have a lot of rules and regulations as to when they can actually purchase Bitcoin. And when you have a federal level law that says, we will perform annual audits on these said cryptocurrencies, you have to be a vetted entity to issue it. That gives effectively a green light for these institutional investors to actually start purchasing Bitcoin. And that's what we've seen ever since, again, US spot Bitcoin ETFs were launched, and also from July onwards when all of this regulatory stuff was approved.
Gotcha. So it really does change the risks involved for investors and the protections as well.
That's right, yeah.
Okay, great. I just want to talk around the practicalities of investing in cryptos and Bitcoin and whatnot. There's this sort of cold storage and hot wallets. What does that actually mean?
Yeah.
Can we explain that simply?
Yeah, sure. So I guess the difference between a hot and cold wallet, it effectively is just one way to purchase cryptocurrencies like Bitcoin. A hot wallet is what we call, they're typically connected to the internet, it's online. And generally, you would use a hot wallet when you want to transact a little bit more frequently. Now, that's the benefits of a hot wallet. The sort of disadvantage of that is that because you're connected to the internet, there's probably a high risk of security concerns. So people hacking into this wallet, finding out what your key is. So that's where the cold wallet comes in. So opposite to being connected to the internet, it is an offline wallet. Again, the benefits of that is naturally it's going to be a lot more secure because you're not, being as prone to the security attacks, but you can't transact as frequently. And so what some people might do is actually combine both hot and cold wallets. So they might use a hot wallet to have small amounts of Bitcoin to transact a lot more frequently, and then use a cold wallet for larger sums of Bitcoin that they want to store a bit more safely. So that's what some people do. And yeah, that's at a high level, the difference between a hot and cold wallet. We can touch upon a little bit later on purchasing Bitcoin through exchange and also through ETFs as well.
Great. So the two types of wallets is all to do
Mm.
with the custody, how it's owned, and the security risks. And that's a great summary for everyday people need to know. Yeah,
Yeah,
let's go into that then. The purchasing and buying crypto directly.
yeah,
There's buying the direct crypto, and then there's the ETFs that also get you exposure. And you don't have to deal with wallets and exchanges in that circumstance. Can you walk us through the pros and cons of each? And I guess
yeah.
when each would actually make sense to do?
Yeah, sure. So exchanges are one popular way of purchasing Bitcoin. Some of the most popular exchanges out there on the market are Coinbase, based in the US. Now, the issue with these exchanges is that you are subject to what we call custody risk. That is a risk where you effectively ask, can someone that has control of this Bitcoin give it back to me? And so we saw issues of this when FTX collapsed in recent years in November 2022. So if you actually purchase Bitcoin through that exchange, you would have lost your money. So you do carry custody risk when you're purchasing through an exchange. And that's where simple solutions like an ETF can provide investors clean access to the price of Bitcoin without having to set up your own hot wallet or cold wallet, deciding if you wanted to do hot or cold, and also if you run the risk of purchasing on exchange. Again, they have recently been issued in Australia. BetaShares does offer a few crypto ETFs that we recently launched. We do have QBTC, which is the BetaShares Bitcoin ETF, and QETH as well, which is a BetaShares Ethereum ETF. So those are some of the pros and cons of purchasing, I guess, through exchange and through ETFs.
Yeah, great. There's some alternatives to holding it directly, and you've just name dropped a few options through the BetaShare suite as well. And I think that would be really an allure or an attraction for someone having to not worry about the exchange. Is that reputable? Worrying about your wallet and the storage of it. So that sounds really good. Where does crypto typically fit then in terms of practicality? So you've spoken before about the volatility of it. It's getting better, but it's still highly volatile. So you're probably saying it's more of a growth part of someone's portfolio. And as such, if you're going to own it, it needs to be with a long-term view and lens.
Yeah, that's exactly right. So generally, crypto has been viewed more as a growth asset. I mentioned that rising correlation with equities in investors' portfolios. Just to reiterate, an allocation to cryptocurrencies should, in BetaShares' view, shouldn't be no more than 5%. Again, your viewers can click on and view the white paper that I'll send to you shortly, John. But what we really found from that research paper was that when you do add a small allocation to Bitcoin, even just 1% to a broad diversified portfolio, you can actually increase your risk adjusted returns. So risk adjusted return really is the return that a profile or portfolio is providing, accounting for the level of risk that it is also generating. So that has increased. And we also found that the impacts of rebalancing your portfolios with Bitcoin also helps add to those risk adjusted returns. Generally, if when you start to rebalance, whether that's monthly or quarterly, you can improve your risk adjusted return over time as well. So a lot of that finding can be read in the white paper.
Brilliant. I'll add that. That's good. And on the flip side, is there a particular someone that just crypto would not suit, do you think?
Yeah, so I think, yeah, this is a great question because investors can often be hooked onto performance and chase performance, but it's really important to take a step back, because every investor is very different. Someone who's 25 years old and just starting investing has a very different need and investment objective to someone who's in a pension phase and retirement, where they actually have to draw down on their capital every single year, and there's more need for income. Remember, I said Bitcoin and cryptocurrencies pay no dividends, there's no intrinsic cash flow. So I think where crypto does not suit is generally those investors who are a bit more defensive in their investment stance and generally have a shorter time frame. It can definitely be beneficial for someone with a longer time frame and no need for income or dividends. But having said that, I think regardless of your age, generally crypto is still a nascent asset class and there's still time for it to develop out. And so again, that's why it should have a relatively small allocation within your portfolios.
Yeah. Brilliant. I've just got a few rapid fire questions to tie us off from some of our client base. So in your view, is it too late? Did we miss the boat? Did we miss the bubble with crypto?
Yeah, I don't think so, is my short answer. And the reason why is because a lot of these positive developments that we've seen have only just happened in recent years. So I talked about US spot Bitcoin ETFs. That came into the market January 2024, so less than 2 years ago. And all of this positive regulatory development that we've seen in the US out of Washington, all of that happened over their summer. So in July, there was a big push for Crypto Week, the Genius Act, etc. And naturally, this is really the start of something that I think is going to be more of a mainstream asset class. So I don't think it's too late necessarily.
Yeah, great. And just around all this other stuff, scams, exchanges, collapses, people losing money, that sort of stuff.
Yeah.
If someone's going to get into crypto, what sort of stuff do they need to be watching out for? How do they best protect themselves?
Yeah, so I think in order to be aware of the risk, you really have to look at who's issuing the said investment offering. So again, I mentioned there are various ways to purchase Bitcoin, whether that's through a hot or cold wallet. Firstly, ask yourself who's offering that wallet, or an exchange like Coinbase. Yes, Coinbase is very established, but again, there's always sort of risk involved if that said custodian does fall under. So you do need to look at their financials, how much cash they have, how much debt they have, etc. And also ETF issuers. Every sort of issuer does carry some risk, but BetaShares, obviously, we've been in the market for many years and we've crossed over $55 billion in assets. And ETFs are a very convenient, transparent way for investors to get access to Bitcoin. But I think obviously just do your due diligence and you can often find things that might be a bit prickly.
And that comment on the issue is the one I see that trips people up a lot. So often they're black boxes with no oversight, no regulation, and a lot of risks. And just one last one. What's one common mistake investors when it comes to investing in crypto?
Yeah, one common thing is some investors can be a bit too jubilant and might just put all their eggs into crypto. I have had some personal friends and family suggest if they should put X amount of dollars into crypto and not consider whether they need their money in the next day or years. That can be a big mistake that I often see people do, which is just putting all their money into one basket. Again, investing is a long-term journey. There are risks involved, but if you do the right thing and you do diversify across asset classes, regions, sectors, then you're setting yourself up for good success. So I'd say that to those investors.
Brilliant. How good's that? Thanks so much for taking some time with us, Hugh. Where can people find a bit more about you and BetaShares? Where's the best place?
Sure. The best place is our website, so www.betashares.com.au. If you want to hear more from me and the investment strategy and research team, there's also an insights page on our website, which is at the top hand corner. Any sort of market commentary you want to read more about or specific funds, we should definitely have an article there. So that's where you can find us.
Brilliant. Thanks so much for your time. Thanks for demystifying crypto for us, and we'll chat to you soon. Thank you.
Right. Thanks, John. Appreciate it.
That's it. Thank you for his time today. The key takeaways are understanding what crypto is and isn't, acknowledging the risks and the volatility associated and where it can play a particular, broader plan, and also understanding the practicalities and how to get involved in cryptocurrencies. If you would like to explore how cryptocurrencies can fit into your broader portfolio or any other investments may or may not fit, you're very welcome to get in touch with us. Take care. Chat soon. Bye.